Hey guys, George Rivera here with Simple Lending Mortgage. If you saw my part one of the How to Buy a Home series, now I want to go ahead and follow up with part two. We already talked about getting pre-qualified. You can see that on my channel. Now we're going to talk about going home shopping. This process is very often misunderstood. So I want to be able to walk this through so that you can understand exactly how not every 200,000, for instance, not every pre-qualification is going to be the same. It is going to vary home to home. I have a perfect example here. I have one client that we actually did pre-qualify. We went FHA and we did it up to 200,000. In this whole ordeal, the customer went and actually first saw a double wide manufactured home. It was beautiful, fully renovated, a lot of land. The customer loved it. When we did the numbers, the customer was shocked to find why the total payment for that loan came over what his proposed budget was. And I want to break that here down for you. So, first of all, with manufactured home, we have to know one thing. There are going to be less financing options. Not every lender actually works for manufactured homes. There's going to be a lot of overlays. Some of them are going to input certain things, and these are things that you're not going to know until you actually start the underwriting process of the particular home. There is higher interest rates with manufactured homes. Every bank has what is called a risk-based adjustment for the interest rates. So they do have a uptick on the rates for these type of homes. So you will qualify, you will get a higher rate when it is a manufactured home. It's a small uptick, however, it does make a difference, and I'm going to show you that here. There is also a possible higher out-of-pocket expense. For instance, when you're doing a manufactured home, you have to do what is called an engineering report. This is going to be an engineering certification that the foundation is actually permanent. Manufactured homes with FHA, VA, USDA, even conventional, they're not doing a mobile home, they're doing a manufactured home. It's a mobile home that has basically already expired and surrendered the titles, because they're like car titles, and they have become real property. They are now permanently affixed to the foundation. This has to be actually certified by engineer, so that it's an expense. Also, manufactured homes are usually more in a rural area, so if they have private water and well, septic, they will require water tests. So these are expenses that not every time the seller is going to pay, and they will pass that expense to you, the buyer. And these are expenses that you have to actually incur in order to get the loan underwritten before we close. So these are, again, potential higher out-of-pocket expenses. So let's go back to the $200,000 on this home. Now, because of the uptick in interest rate, we're going to see that the principal and interest payment is actually slightly higher than when we went ahead and priced it for a townhouse and a regular home. The homeowner's insurance, you can also notice, is actually higher than the townhouse and the home, because they're considered higher risk because of obviously the stability, the integrity of the property as a whole. The property taxes actually is very equal. That is more based on obviously the millage rate in the county and the proximity to certain things. So that didn't change much, as well as because the price point was on par. There's no HOAs in manufactured homes because obviously they're rural, they're not in PUDs and planned unit developments. Now this particular manufactured home was in what is called a flood zone. So the flood insurance here was 8683. Being an FHA, you do have your mortgage insurance premium. Now because that is a percentage based on the loan amount, that stayed fair even. However, look at the payment. It was $1,336.96 was the total monthly payment for the $200,000 FHA loan on a manufactured home. Customer was thinking not to go over $1,200 because that's obviously what the realtor had advised, and that's obviously what is par when you're doing simple math in your head on what a proposed payment should be based on that purchase price. So the customer decided that was kind of a high payment for a manufactured home. They moved on. They found this beautiful townhouse. Now, I got condo and townhouse only because we have run into what is really supposed to be townhome, but the owner has actually classified it as condos. And once it is considered condos, that actually changes the whole game because there is significantly less finance options for condos. But in this case, she actually went and found a townhouse. Big, spacious, pretty, decided that if it was going to save money, it was going to be, she was willing to surrender the yard because there was a lot of amenities that the community provided. When we priced this, so we did get a better interest rate because we're not a manufactured home. The insurance was significantly cheaper because when you're in a townhome, you're getting what is called 4 walls in. You're only insuring what's inside your 4 walls because everything outside your walls is actually covered by the community, the association. However, the taxes were higher. Now, townhouses, as well as condos, they have HOA, homeowner association, or condo fees. So there's an extra $200. We were not in a flood zone. FHA, MIP, still the same because it's a percentage based on the purchase and loan amount. But that put it at an overall payment of $1,398. So it actually went completely the opposite direction. So again, the customer was kind of not wanting to go over that budget. She wanted to stay under $1,200. And this scenario right here in this particular townhouse threw her over. In the search, customer found a house. Single family residence, detached home. It was not in a HOA area, big 4.3. She actually fell in love with it. I think it was a good purchase considering where the market has been going recently. Now, this being an FHA loan got us the same exact interest rate from a townhouse compared to house. So we still get a principal interest of $763. The homeowner's insurance was a $1,200 annual premium policy, so it's $100 a month. The property taxes was actually pretty in par. It was $180. There was no HOA, no flood. FHA, MIP was the $135.26. And this one right here put the customer at an actual total payment of $1,178.48. And this is what the customer was actually trying to stay within. She was happy with the purchase. This is how we went through with it. And this is actually what she opted to go with. But I wanted to show this because a lot of the time when I pre-qualify, at least here with Simple Lending, when we pre-qualify you, we try to be proactive. We actually try to get in front of all of this, and we give you a lot of information. A lot of time, the realtors feel that we gave too much information, or in some cases, they even think that it was confusing information. What we're trying to do is simple. What we're trying to do is show you that just because I gave you a pre-qualification letter for $200,000, it does not mean that every option that you find out there, as long as you're at $200,000, you're going to have the same payment. As you can see, we're looking at a quite significant difference from the $1,398 to the $1,178, and this is just a matter of what house was picked or selected. So it does make a difference, and this is why I always say, get pre-qualified first. This is where we talk to you about the payment. This is when we talk to you how we derive to this payment. So we can break down for you, hey, Mr. Customer, this payment is based on this scenario. If you do come across any different scenario, this can change. So when you're home shopping, before you fall in love with the house, before you fall in love with a particular, whether this had a nice yard, whether this had a lot of community amenities, we want to be able to instill that information so that you're more prepared. Because this customer, after going from the manufacturer to the townhouse, actually considered the benefits of the townhouse, but did not expect the price change. And this is where, had we been involved, we always tell our customers, before you make an offer, before you fall in love, if you see a house that you like, you're not bothering us. We're not that weird uncle in Thanksgiving. Please feel comfortable talking to us. This is where we want you to say, hey, George, I found a house. I'm thinking of making an offer. Here's the address. Can you tell me what that payment looks like? And we'll run that for you. We do not have a problem because we're here to make this journey smoother, easier, and simpler for you, the customer. Because there's nothing worse than us being blindsided with either an offer, a counter offer, than being asked for a pre-qualification letter. And then we have to give you these facts. And then, that's not really what I'm looking for. That, why is it so high? What happened? This is where we want to explain this to you because we want to make the home shopping experience smoother. This is just like going to a car dealer and falling in love with the limited edition car. And then when they give you the price, you're completely bummed out. And then you want to go and talk about a car that's within the range that the financing department qualified you. And then they show you the base model with the hubcaps and the cloth seats. You can't unsee that limited. We don't want your home shopping experience to feel like at any point you're settling. We want to nail down what is your budget, what are you looking for, what is the range you're trying to stay in. So when you're out there shopping, you know exactly what you're expecting. So when you do make an offer, you're making your best offer. So when you go under contract, all we have to do is just bring it home. So I hope that now we can understand why the pre-qualification process is so critical to do it first, because this actually goes hand in hand with the home shopping part of it. And this is what we do before we go into making an offer. So stay tuned for part 3 on making an offer. This is George Simple Lending Mortgage. Thank you.